Hi, everyone. I'd like to welcome you to the second installment of Moving Forward by Looking Backward. And this installment is entitled Can Negative Be Positive? We've actually broken Can Negative Be Positive into two parts. This first part will focus on the intersection of monetary policies of central banks and fiscal policies of governments, and how these policies have contributed to very low global interest rates and increasingly high global debt. To tie this back to the first installment of Moving Forward by Looking Backward, there is reason to believe that these outcomes of low rates and high debt are a result of government institutions applying unconventional approaches to meet the economic growth expectations of society. Expectations that we think are actually highly unrealistic based on labor force growth and productivity growth challenges, which we highlighted in the first installment of Moving Forward by Looking Backwards. Thank you very much, and I hope you enjoy. Before moving into the material, I would ask that everyone takes note of the disclosure language. Please note this is for informational purposes only, and please consult your financial advisor before making any investment decisions. Since this material is not tailored to any one particular individual situation, Abe Capital Management's views may change as new information becomes available, and we may not be able to provide an update should this happen. Economies grow through periods of faster growth and sometimes slower growth and sometimes a declining growth, recessions. Governments try to moderate these cycles and especially the extremes in these cycles. And to meet their implicit growth targets, sometimes based on arguably unrealistic the goals of their constituents, the governments have attempted to engender the growth through financial tools, namely monetary policy and fiscal policy. In simplistic terms, monetary policies are actions by monetary authorities, think of it as like a central bank of a country, that try to control the interest rate on short term borrowing or to try to use money supply to target a certain levels of economic conditions. Increasingly, central banks have used unconventional measures, or at least by any historical sense, unconventional measures, to influence market prices in hopes of creating certain economic conditions that were not being achieved through conventional measures. Although there's debate over the impact and merit of these efforts to create a wealth effect by increasing asset prices, they're almost certain to have impacted the cost of borrowing. Effectively, this has helped government's ability to use fiscal policy, in this case, more spending and less taxes and greater debt, because the cost of the debt has continued to decline. Kind of like a person who can refinance their mortgage at ever lower rates, you can assume more debt and still cover it comfortably with the same paycheck. In the chart on the left, you can see that global debt as a percentage of global GDP rose modestly from about 100% to about 120% between 1950 and 1980. Since 1980, the level has nearly doubled to roughly 220%. While much of the debt growth was driven by advanced economies until the financial crisis, since 2007, all of this growth in debt relative to GDP has been driven by emerging economies, with China being the predominant driver. For context on this, 246 trillion of global debt is roughly 32,000 for every person on planet Earth. According to the Global Rich List, a $32,400 annual income would put a person amongst the globe's top 1% of earners. In this slide, just as the debt growth shifted from advanced or developed economies to emerging economies since the global financial crisis, you can see there's been a shift also within economies. In this chart, you can see that financial corporations, think large banks and households, have generally reduced their debt as a percentage of GDP, while corporations and especially governments have increased debt significantly. Most noticeably, developed economy governments have increased their debt as a percentage of GDP from roughly 70% before the financial crisis to roughly 110%. So is government debt actually a problem? Before we get into this question, it's crucial to remember that governments have tremendous assets too. From an International Monetary Fund paper entitled Managing Public Wealth, the IMF does an exceptional job highlighting both sides of the government balance sheet and how this changes over time. As you can see on the chart on the left, governments own large swaths of land, public buildings, mineral and energy resources, gold and currency deposits, as well as maintaining the ability to tax both the people and the land and the properties within its territories. They obviously have debt obligations, pension obligations, and daily obligations to fund the military and healthcare and education infrastructure. But when you look at it, the assets minus the liabilities are effectively the net worth of the governments. The chart on the right shows that 17 developed countries still have a positive net worth in 2016, despite all of this debt growth. That being said, this net worth has declined from roughly 40% of GDP to roughly 16%, 17% of GDP over the decade ending in 2016. The chart on this slide is perhaps an easier visual, showing the weighted average of these 17 countries, which experienced a net worth decline from roughly 40% to 17% over the decade ending in 2016. But again, this is the weighted average across 17 countries. Before moving on, let's take a quick look at the US specifically. According to the IMF, the US is among the one third of nations in the 17 in the previous slides who actually have a negative net worth. The chart on the left illustrates that the US net worth by IMF measures has declined from roughly 50% positive prior to the global financial crisis to 17% negative in 2016. Although this gradual decline hasn't had a material impact on the interest costs or the value of the US dollar, what happens when we do have an economic recession? Before answering that question, you can see in this chart that the US has maintained what is generally referred to as a twin deficit, meaning a current account or trade deficit, which is in the dark blue, and a budget deficit, which basically means we spend more than we bring in via taxes in light blue since the 1980s. We only experienced a slight surplus around the height of the technology bubble. In this regard, it's important to note two things. First, our trade deficit has declined significantly over the past decade as energy imports, which can be seen on the chart on the right, have been virtually eliminated, whereas they used to run close to 3% of GDP. A chart on the right highlights the nominal change from nearly a $500 billion annual deficit only a decade ago. This has been largely a result of innovation in the oil and natural gas industries, the shale boom, which has provided tremendous reduction in the need to import from abroad. Despite the benefits, the economic benefits of this energy renaissance, our budget deficit has seemingly become structural, meaning it's hard to see how it goes away, since even in relatively good economic times, with this energy benefit, we're still spending nearly $1 trillion more than we're bringing in via tax revenue. This is actually a huge fiscal stimulus and arguably taking from our future to support our present. This next slide is a bit disconcerting because it highlights that the budget deficit has actually grown by roughly 4% over the past 7 US recessions and an average of 7% over the past 2 recessions. Why? Because when economies get into trouble, the government does and should spend money to support the economy. This might mean more unemployment benefits, or food stamps, or spending on infrastructure to put people to work. If the budget deficit grew by 5% in the next recession, this would imply that it would be roughly 10% of GDP in that given year. Said differently, our government would be spending nearly $2 trillion more than it would be bringing in via tax receipts. The US government would be spending $1.60 for every $1 in revenue that it brings in. Bring this back to our government balance sheet, the IMF estimates that the US net worth could decline from negative 27% in its baseline projection at the time of the next recession to perhaps negative 54% in a stress scenario. Maybe it doesn't matter because the US Treasury can print money, but perhaps this might impact the willingness of people to lend money to the United States for a decade at 1.5% or so, as the United States is currently able to borrow at. So the government's net worths seem to be in structural decline as they've increased fiscal deficits to support below expectation economic growth. And monetary policy, as we will see, has likely helped keep rates low and encourage this, call it, feedback loop. I titled this slide a bit funny. I titled it The Lower Rates in History instead of the Lowest Rates in History. And kind of the reason I did that is because certain things seem to fly in contrast to history. So typically, your expectation would be when an entity has a weakening balance sheet and it has structural cash flow deficit payments, you might actually expect higher costs to borrow, not actually lower costs to borrow. But actually, what you see here is that government bond yields are at their lowest levels in history. This chart illustrates government bonds over the past 150 years across some of the largest global economies. Now, the market rationale is that growth is low and expected to remain low because of demographics, and inflation is supposed to be low because of excess capacity and the impact of Amazon and technology at large. So, interest rates don't really need to be high to give an adequate return to savers. Um, but also it's important to remember that governments don't really have the same type, or not perceived to have the same type of credit risk, and they're different than a corporation because they can effectively print their own money, and a company cannot do that. And one of the examples that's often cited is basically the demographically challenged Japan, which has had a low growth rate since the early 90s, and its interest rates have been quite low since the mid 90s. Some say that Japan is basically a template for other demographically challenged nations where bond yields will settle in the future. This that this isn't a temporary condition, but rather a permanent one, is what a lot of professional investors are saying. While I don't disagree, I'm not comfortable in agreeing with this thesis either. I do think cycle exists, and I think there is a better chance than maybe some people are anticipating that rates could be higher at some point in the future. Now, while a lot of investors and market forecasters would cite the Japanese example as a reason why we might experience low rates forever, I think there are other examples in history that we can also look at. In the last presentation, we actually showed the long-term economic growth on a real basis in England, and the chart showed centuries of data. And during those many centuries, that had even lower economic growth than today. For example, in England from 1750 to 1900, a 150-year period, economic growth was barely about 0.5% real growth, compared to nearly 2% real growth annualized over the last decade in the UK. Yet, as you can see on the chart on the left, long-term bond yields in the UK are lower than they were at any point going back to at least 1750, and including that obviously 1750 to 1900 time period. So even during this much lower growth 150-year period highlighted before, the long-term bond yield averaged 3 to 5% versus maybe 2% today. The chart on the right shows that real world 10-year inflation index bond yields have been negative for the past 5 years, a situation that didn't exist for the prior 30 years, and then probably a good period before that as well. In the past two charts, we've talked a little bit more about long-term bond yields and how the current bond yields kind of compare to historical periods. Now we're going to kind of look at the United States on more of a short-term basis. And while we've seen negative real rates in the United States in short-term bonds over the past 150 years, these periods have tended to come during extreme economic environments or national emergencies. For example, during the period of years reflected in this chart, there were 34 years, or just less than a quarter of the time, where US real rates were negative. But of these 34 periods, 11 of them were during world wars, four of them were right after 1929 during a massive deflationary era, and six fell in the massively inflationary 1970s. And kind of this all makes sense. As we'll see from the Norman Rockwell image tying investment to patriotism and a national cause, people were willing, especially in extreme socioeconomic environments, to invest in a safe, nationally aligned government bond, even if the real return was negative. In contrast, there were only 9 years prior to the global financial crisis with negative yields that weren't in one of the eras highlighted above. In summary, what many investors have come to believe is the future norm is truly the exception across time and also as we've seen across geography. Perhaps most important to keep in mind is that negative real rates in the short term have never remained a permanent condition. And if we recall the chart of long term bonds over the past 150 years across various developed countries, or the England example of low growth from 1750 to 1900, and the nominal yields that range from maybe call it 3% to 7% during that 150-year period, this chart should stand out for two reasons. First, it appears that perhaps only 3% of the global bond market recently yielded 4% or higher, which might have been deemed the average for the historic risk free rate. Secondarily, perhaps over 20% of global bonds yielded negative returns. So let's think about this for a minute. I give you money for, let's say, 10 years, And in 10 years, I get back less money than I gave you a decade earlier. And I also assume the risk that you default and don't even pay me back what you owe me. And this doesn't even account for the loss of purchasing power due to inflation. To widen out this perhaps extreme allocation of capital, if you include bonds that yield less than 2%, including negative yields, this would encapsulate 60% of bonds. Remember, in the prior 150 years, sub 2% nominal yields on theoretically risk free long term government bonds had, with the exception of Japan since the 1990s, never been that low. And recently, 60% of global bonds, including entities that can default because they can't print their own money, are yielding below 2%. And perhaps only 10% of global bond bear yields that we would have perceived to be normal across geography and time. Warren Buffett has been quoted as saying, the most important item over time in valuation is obviously interest rates. If interest rates are destined to be at very low levels, it makes any stream of earnings from investments worth more money. In an effort to stimulate growth via access to really inexpensive short term capital, as well as an attempt to force investors to take incremental risk, and in fact, create a wealth effect through higher asset prices due to low interest rates, the two other large central banks, being the European Central Bank and the Bank of Japan, have effectively kept rates on the short term close to zero or negative for nearly a decade. Although the United States attempted to raise the federal funds rate from 2016 to 2018, things started to break down when they reached a peak level of just above 2%, which might have been considered a trough or below trough in past cycles. Is something broken? For a bit of bond market context for those who are less familiar, while historical convention was that central banks might control short term interest rates, otherwise known as the short end of the curve, through setting of overnight lending rates like we saw on the prior slide, the market typically drove the longer term rates or the long end of the curve. Credit securities of different types, whether corporate, municipal, agency, or even equities, would often yield a commensurate spread or a higher rate or cash flow to a similar maturity date of something like the US Treasuries that were risk free. If a corporate was very cyclical in terms of its business and had a lot of debt, it would require a much higher yield than a similar maturity US Treasury bond. In contrast, a quality franchise that was not very cyclical and had a minimum amount of debt might bear an interest rate that was only modestly higher than a similar maturity government bond. But securities were typically priced in comparison to the risk free alternative, both to spur economic growth and borrowing lending, as well as to engender higher valuations on securities and a broader societal wealth effect and commensurate spending. Central banks globally decided to purchase not only government bonds, but also corporate bonds, stocks, ETFs, etc. Here we see a chart of the Fed, European Central Bank, Bank of Japan, and Bank of China expanding their balance sheets from $5 trillion just before the financial crisis to $20 trillion at peak in early 2018, which interestingly coincided with the peak in global equities as well. In the chart on the right, we see the ECB through 2018 purchased nearly 2 trillion euros in corporate and sovereign bonds. Other institutions on the continent had to follow suit due to requirements or meeting obligations because of their pension beneficiaries or what have you. It'd be logical that many trading-oriented investors similarly front-run this massive pool of buying capital, almost in a greater fool theory, but a known big buyer behind you willing to buy anything that you want to sell. And yields got pushed lower and lower, especially where central bank intervention was the most meaningful, like in Japan and the European Union, where investors sought alternatives from negative yielding government debt. In conclusion, in part one of Can Negative Be Positive, we highlighted the growth in debt at the societal level over the past few decades and how this compares to societal assets. And we do this across geographies to a large extent. We walked through how this increase in debt has been accompanied by lower and lower interest rates, which effectively make the financing of such growth much easier to achieve. How much these lower rates are the result of historically unusual, and some would say unconventional monetary policy by central banks around the world to both set the short-term rates at very low levels, as well as be an active participant in longer-term government bonds as well as other securities, is really a matter of debate. Needless to say, it has led to some very unusual outcomes which we will discuss in greater detail in part 2 of Can Negative Be Positive? Looking forward to sharing that with you. And until then, take care and be well.